Hello and welcome to Commodity Culture, where our goal is to make you a better investor in the commodity space. My name is Jesse Day. Before we dive in, standard disclaimer, nothing here is investment advice. Do your own due diligence. And today's episode is sponsored by ARC Silver Gold Osmium. They offer personalized service and competitive prices with no minimum purchase for silver, gold, platinum, or osmium. Here's just some of the comments left on this YouTube channel about ARC SGO and owner Ian Everard. Have bought from ARC, good source and price. I cannot say enough good about Ian and his company. He is the most honest individual I could find in order to buy precious metals. If you are looking to buy precious metals, I recommend Ian at ARC Silver. He is a straight shooter. So go to arcsgo.com and contact Ian Everard today at 307 264 9441 or by email at ian@arcsgo.com, and make sure to tell him that Commodity Culture sent you. And today's guest is an expert on precious metals markets and commodities, an author and analyst who has advised many of the world's largest corporations and institutional investors, and the founder of the CPM Group. It's Jeffrey Christian. Great to have you on the show.
Thanks for having me, Jesse.
Yes, happy to have you on. I want to start with precious metals. We're going to get into copper, uranium, and some other commodities a little bit later, but let's first get your broad view on the gold and silver space. What are the main themes and trends that you think investors should be paying attention to when it comes to precious metals right now?
Well, right now we're seeing very strong gold and silver prices, record levels in gold and moving toward record levels in silver. And that's being driven by investment demand. And the investment demand in turn is being driven by concerns and uncertainties. There are people who say, well, gold only trades against the dollar, or gold and inflation's the only thing you need to know. And that's actually not true. And what you find with gold and silver is they trade against uncertainty. So, if the dollar is weak, but everybody is gung ho on the euro, it doesn't do any good for gold. Or if the dollar is strong and, it doesn't necessarily do anything for gold. So it's really a complex web of uncertainties, economic, financial, and political, that are driving investors into gold. And just staying with the gold and the dollar, for example, people keep saying, well, how is it that you can have a strong dollar and strong gold prices? And the answer is the dollar and gold are the two assets that are seen as the least risky among financial assets. And when things get really hairy, as they are now, investors around the world, they want U.S. dollars, over any other currency. They want U.S. Treasury securities because they are seen as the least risky debt instrument, and they want gold, and to a lesser extent, they want silver. And that's what you're seeing right now. You're seeing this incredible list of economic uncertainties, political risks, domestic in the United States, Canada, Europe. You've just seen some rather remarkable elections in the UK and France. You have political risk, domestic political risks, and international political issues commanding more attention on the part of financial markets than they have for many years. And on top of that, you have the economic and financial market issues. So you've seen a lot of investors pulling in to gold and silver. And our view is that's going to continue, that those issues don't get resolved, and they don't get resolved soon, and that you have this heightened period of investor anxieties driving them to add to their gold and silver probably through next year and probably into 2026. Yeah. So that's the main overarching thing. There are other topics like, there's a lot of overhype about silver use in solar. There's a lot of overhype about central bank gold purchases. But the key core and the single most important thing an investor needs to know is we live in a era of heightened uncertainties, and that is driving investment demand for gold and silver.
Well, let's talk about this hype because you also published a piece on Chinese silver prices. I want to get into that in a moment, but first you mentioned silver and solar and you mentioned central bank gold buying. Now, I've spoken to some people who think that silver use in solar panels is going to skyrocket the price of silver. It's one of their main investment themes. I've spoken to other people who believe the opposite, people who are in the middle. What is your thoughts on silver in the solar market? Why do you think it's being over exaggerated?
I think that we're in the middle. You know, solar panel manufacturing is rising. Uh, More important, well, solar panel demand is rising. Solar panel manufacturing is rising more than solar panel demand, which is leading to inventories. And the capacity to make solar panels is rising more than solar panel production, which means that the capacity utilization rates in the solar panel industry are really low and probably going to fall. And that means that the manufacturers may not be profitable and you may see, a wall there. But, from a long-term perspective, solar panel is economically viable with traditional energy sources. And it has been a tremendous source of growth uh, for energy production over the last few years and for silver use. It's not nearly as great as some of the silver promoters think. I don't know where they're getting their numbers, but then if you talk to the solar panel industry, they give you some pretty amazingly strong numbers. And we're probably looking at a slowdown this year in the growth rate because we overbuilt last year. So there are a lot of unsold panel inventories, and that may continue into 2025. And depending on what happens economically, if we slip into a period of even lower growth or a recession in the United States and some other countries, um, you could actually see the amount of silver being bought for use in solar panels flat for a year or two. Long run, it's probably going to rise. It's not going to put a problem. It's not going to cause a problem in terms of um, not enough silver to meet solar panels. I mean, people who are talking about 800 million ounces of silver per year in new silver use in solar panels are just off base. Yeah. But that said, it is a strong new market for silver.
Well, let's also separate hype from reality when it comes to central bank gold buying, because this is another theme that has been very pervasive when it comes to discussing gold. Some people saying that the entire reason that gold reached all-time highs was completely because of central bank buying around the world. What are your thoughts? Do you think that's being over-exaggerated as well?
I think that's being over exaggerated. It really started a couple years ago when the people who supply the World Gold Council data got some information from China and they misinterpreted it. And it was actually bearish information, but they interpreted it as being bullish. And the core is that the People's Bank of China still serves as a quasi market maker, but they don't make markets anymore in silver. But what they do is they help domestic producers and sellers of gold and consumers and buyers of gold. They help them. And in 2022, you saw this 75% decline in demand for gold from the first quarter into the fourth quarter in China. And in that environment, there was a lot of gold that was being sold that couldn't find a home. The Chinese government's policy is the gold in China stays in China. So if you're selling gold, you find a Chinese buyer. If you can't find a Chinese buyer, ask the PBOC for help. And there's about 10 million ounces of gold that built up in this side account, this trading account that the People's Bank has, not its monetary reserves. This was not gold that they had bought for their own account. This was gold that they were asked to find homes for. So it's really a bearish signal. Demand for gold is plummeting in China, and people are asking the People's Bank of China to take it off their hands and find a buyer. And the gold price went from, 2,060, $2,040 in the first quarter of 2022 down to 1,640. And at that point, the People's Bank of China started buying. People's Bank of China had not bought any gold from 2019 when the price got over $1,350. They stopped buying in July, August of 2019, and they stopped buying. They said, no, we've been buying at 1,200, 1,300, 1,350. We're not interested in buying at 16 or 17 or $2,000. When the price came down to 1,640, they said, okay, this may be the new level, the new base. So they started buying, and they were buying out of that pocket of 10 million ounces. Other people saw that they had they had acquired that 10 million ounces, and they thought it was in addition to central bank reserves. And that started a lot of hoopla. And the World Gold Council, to its value and credit, initially said, hey, we got this report that this metal's been bought. They didn't say that it was Chinese bank by a central bank, but we haven't had that verified. Yeah. But it's still on their books as having bought it. So there was this view that there had been a net purchase of gold of 20 million ounces in 2022 by central banks, which was wrong. It was closer to 10 million ounces. Now, central banks have been buying gold, and the People's Bank of China started buying gold again in November of 2002 and bought gold from then into April of this year. In May, the People's Bank bought no gold. Why? Well, the gold price spiked up to record highs, and they said, we're not going to do that. And in fact, you saw other countries like Uzbekistan and Turkey, which have been buying gold for their central bank monetary reserves. They were also sellers in May. And so what you've seen is what we've always seen, which is that central banks are more price sensitive than private investors. So when the price rises, they won't buy. When private investors pull back and the price comes down, they'll buy. Central banks like to buy low and sell high.
Yeah, that makes a lot of sense, and it's very interesting to hear you kind of help separate the hype from the reality when it comes to those two factors. And another one where I'd like your assistance to do that is silver prices in China. You last month you released a CPM market commentary on Chinese silver prices. Here's a quote: "There is some confusion in the investment community about silver prices in China, which are different from those quoted in London or New York. This is neither unusual nor unique. The current misunderstanding is preventing investors from fully grasping important developments in the Chinese market." Now, I've spoken to several people who point to the price difference, the arbitrage there, so to speak, in China as a bullish indicator for silver, that it's trading at 12, 13% higher than other markets. Is this also a misunderstanding?
It is, but let me just finish up one thing with central banks. I don't want to come across as saying that central bank demand for gold is weak. It's been about 10, 11, 12 million ounces a year over the last several years. It's probably going to be close to that again this year. Maybe not because of the higher price. But, the reality is that central banks have been buying on net, on average, about 10 million ounces of gold a year since 2008. And they seem to be on pace to continue to do that for the next 10 years. So that's there. Now, with China, there's a lot of weird things going on there. And one of the things is that when people look at Chinese silver prices, they tend to look at the Shanghai Futures Exchange future silver price. And that has a VAT attached to it, as quoted. When you actually trade the Shanghai Futures Exchange silver futures contract, you don't pay that VAT. You only pay it if you take the physical delivery, right? So that's the number that's readily available in the West. So people look at the Shanghai Futures Exchange futures price and they compare it to the London spot price or the New York nearby active price. And they see it much higher because it's got this VAT added. Got to take the VAT out. Most of the silver that's bought, physical silver that's bought in China, is actually bought and sold basis the Shanghai Huatong silver exchange price, which is a spot physical price, and it's different from the Shanghai Futures Exchange price. So the first thing you have to understand is if you want to know about the difference in actual silver prices on a transactional level between London and New York and Shanghai, you can't use the Shanghai Futures Exchange price. You got to stop. So you're dealing with uh, a market that you don't have basic data for. Yeah. That said, there does seem to be a premium in China for silver, even though it's like, I guess, the second largest producer, it's the largest user of silver. There's a tremendous market there, not only for domestically produced silver, but also silver that is refined from imported base metals concentrates, lead, zinc, copper, concentrates with high silver content. And that comes into the market. And then China is using this silver for a variety of fabricated products. Some of the fabrication demand is showing some weaknesses, partly because there is a shift away from using China as the manufacturing site to using places like India or Vietnam or Thailand as the manufacturing site. So the Chinese market is a lot more complex than that sort of simplistic view. Well, look at the big premium of Shanghai over London.
Excellent breakdown there. I want to talk about a recent video you released on the CPM Group YouTube channel. And you said in it, the gold market is inextricably bound up with politics. Walk us through that, because I get the same sort of comments that you were mentioning in that video. Stick to gold and silver. We don't want to hear anything about politics. So walk us through that and provide your thoughts on the current political and geopolitical landscape and how it could influence the gold market.
Yeah, it's incredibly naive that people complain about talking about politics because, gold is politics, and politics are heavily influencing gold. And gold has always been central to politics, and political developments have always been central to the gold market. And, you have to admit that. We've seen, starting in the year 2000, we started seeing people not wanting to talk about politics, and going out of their way, when pollsters or reporters or other people would start asking them substantive questions about politics, they didn't want to talk about it. And it's really bizarre. And, Noam Chomsky had this great thing. He said, if you listen to talk radio, if you listen to a sports radio program, people get on and they know numbers and they know all kinds of information, and they're very willing to talk about their opinions about it. And if there's an expert like a sportscaster, they're willing to say, no, you're full of shit, excuse my language, and challenge the expert views. But if you turn over to a political talk radio show, people are docile and they listen, and they're not looking to have a discussion or a debate. They're looking for confirmation of their beliefs, their opinions and views. And it's really sad, but that's the way it is, And there, people are reluctant to talk about the things that are important, and so, but it's there. But one of the things that we've been saying for about a year and a half now is that we thought that going into the current period, 2024, 2026, we would see political uncertainties, and that's a euphemism for problems, domestic and international, becoming much more prominent in the minds of investors and much more a factor driving them to add to their gold positions. Usually it's economics and financials. What's the stability of the banking system? Last year we had three medium-sized banks that ran into financial problems in the United States, and people freaked out. And they were buying gold for a couple days or a couple weeks based on that. Usually it's those economic or financial factors that are the key drivers for investment demand. But I think right now you've got a world where the political systems are in flux, and there's heightened concerns about the shape of things to come. I've been singing "It's beginning to look a lot like the '30s everywhere you look," and it is. And you've got some of the same tribalism and nativism and anti-globalization and trade wars and trade obstacles and stuff. You have a lot of things that are coming together in the political environment that already are causing weaker economic conditions and more volatile financial market conditions. And the overriding sense is that these things are going to get worse before they get better. So it's politics driving economics and economics driving investment demand for gold.
Well, the CPM group projects prices for gold, silver, a variety of metals and commodities, and you have very short term, intermediate term, and long term outlook. So, looking specifically at gold and silver, could you tell us where you stand on prices for those time frames?
On the ultra short term, like July and August, we would let's just start with gold and then we'll go to silver. For gold, we're looking at the gold price having some vulnerability. Politicians keep going out of the way. I'm sorry, I'm looking at my price screen and the prices just disappeared. so, um, Gold and silver have some vulnerability to seasonal weakness right now, July and August. That's being overridden to some extent by political problems and political issues. So in the United States, the whole focus on Biden. In Europe, you've had the elections in France, which were really remarkable, and the UK. You have the return of Labour to power in the UK for some period of time. You have a majority of British and Scottish citizens saying we should never have left the EU. You know, and you have a lot of political issues. Then you have Russia, then you have China, you have India. You have political issues all over the world right now domestically. Then you have Russia's invasion of Ukraine and what it means for the whole world. You have China having recently been very more militant in its attitudes toward Taiwan. It may be backing off from that. It's too early to tell. There are impeti, if that's the plural of impetus, within China where people are saying, for 40 some odd years, since the late 1970s, the posture and the agreement, international agreement, was we will see a reunification of Taiwan into the People's Republic of China at some point, politically and peacefully happen. And there was, for a variety of international and domestic reasons, a decision 8-10 years ago in China that we really need to move this forward. And if that means looking for a military solution, maybe that's what we should be talking about. And now I think you've got an impetus among some policymakers within the Chinese Communist Party saying, that was probably a mistake. And we really should be patient and continue to look for a political, peaceful settlement to the reunification issue. The United States in the late 70s dedicated itself and said, yeah, we agree that Taiwan should be reunified with China at some point peacefully. Now, things have changed in the last 40 years, and we sort of realized that was a stupid thing to say 40 years ago. But that's what we had said. And the United States is famous for breaking promises on an international level. Yeah, in the early 1990s, when it became obvious that the only economic solution for Eastern Germany was to reunify with Western Germany, Russia expressed concern because that would expand the eastern border of NATO to the eastern border of Eastern Germany. And the United States orally said, don't worry, we won't expand NATO beyond East Germany. And we obviously violated that several times over, so that the border of NATO countries with Russia is almost universal. The only place where it isn't is Ukraine. Uh, wonder why they attacked. So you've got a history of the United States being duplicitous in its policies, and all of that stuff's coming together, and it's going to continue. Now, you were asking me about the prices. So we don't think that the prices gold has been trading between 2,300 and 2,400 for most of the last month and a half, 2,300 to 2,450 if you want to take it back to April, the beginning of April. We would not be surprised to see the price come down on an ultra short-term basis to 2,300, maybe even 2,285. We think there's some vulnerability. On the high side, we're looking at 2,400, which we got within 70 cents of, and 2,450. So that's the short term, 23 to 2,450. The short term, the next 3 months, we call it, we're looking for the price to test 2,450, going into the U.S. election, and with various other issues coming up, slowing economy. We would not be surprised to see the price over 25.50. Medium term, say intermediate term, which is the next, in our view, 1 to 3 years, we expect gold prices to rise much further. We haven't put a dollar value on the intraday peak, but on a quarterly basis, we would not be surprised to see the price over $2,600 on a quarterly basis over the next 8 quarters. We go out 2 years with our quarterly projections. On a long-term basis, the next 10 years, we think that at some point the economic and political environment gets better and investor fears come off a little bit, and gold prices having peaked in 2026, gold prices come off. We don't see it going back to 1,600 this time, but we do think that gold prices can back off should the economic and political environment get better. That's our main scenario. We have numerous alternate scenarios, including one where things get worse, politically and economically, and then we have gold prices staying higher longer. Silver is a very similar pattern. Would not be surprised to see the price come off to $26.70, $27 or so. We, on an ultra short-term basis, we're looking at 27 on the low end and maybe 32, 33 on the high end. On a short-term basis, the next 3 months or so, we think that the market trades probably 28 to 33, 34. On the intermediate term basis, the next 2 to 5 years, we think that the price could go up as high as $40 on a quarterly basis. We're expecting new record prices for silver. And then, as with gold, our main scenario is that the world gets better and the silver price comes off.
Great breakdown there. I want to shift from gold and silver and look at the platinum group metals. These are metals that are not often discussed. So when looking down the list, not just platinum and palladium, but iridium, osmium, rhodium, and the rest, which stand out to you as having the most potential moving forward, and why?
I think platinum is probably the most interesting. And I'll say, I can talk about the price outlook, and then I can talk about investment demand. From a price perspective, we think that platinum probably does best, because what you're really looking at is that the platinum, palladium, and rhodium, their primary uses are in auto catalysts. Auto catalysts, the market is suffering for a variety of reasons. One is the advent of electric vehicles, which don't use auto catalysts. So that's taken up about 10, 12, 13% of the market. It's reduced the demand for all three metals. In addition to that, you have other demographics that are reducing demand for automobiles. So that is slowing down the demand. The positives for platinum, palladium, and rhodium right now are South African and Russian mine production, which are declining. And you've got pretty sharp declines in South African production this year. And there's a lot of headwinds to current production staying high, and you might see lower production. So the main reason to be bullish on platinum prices or palladium and rhodium prices is that supply may be constrained by mine production and financial issues with the mining industries. That's not a particularly bullish story, especially one where you're seeing contractions in fabrication in the primary use of the metals. So from a price perspective, we think that platinum could rise periodically over the next several years. We're less bullish on palladium and rhodium. There is a lot of platinum and palladium around in above ground inventories, not so much for rhodium. So that's that. Iridium and ruthenium, the prices have risen very strongly, and that has reflected in growing fabrication demand for very small, illiquid, non-exchange traded metals over the last 10, 15 years. Our view is that, and we're starting to see this, you're starting to see substitution and per unit reductions of iridium and ruthenium in a number of uses, simply because the price has risen and the supplies are tight. And we think that that's going to continue. So our expectation is that while the prices will remain high, fabrication demand may come off. And it's like, well, why is fabrication demand coming off? Because the prices remain high and move higher. Osmium, there's some people in Germany who are marketing osmium. I'm not quite sure if it's a scam or I think it is, but I'm not quite sure. Yeah, just it should, it doesn't make sense. The price has been flat for more than 25 years, like 30, 31 years now. The price has been flat around $400, $450, and it's probably going to continue that way. Now, that's the price outlook. On an investment perspective, we advise all but the most sophisticated and talented, well, not even that. We advise investors to avoid rhodium, iridium, ruthenium, and osmium. They're not exchange traded. They're very small. They're very specialized markets. Investors, any number of companies will sell investors these metals, but when it comes time to buy them back or sell them back from an investor's perspective, all of a sudden the price falls, and it falls sharply. And we've seen 100% bid-ask range. You want to buy ruthenium at its peak in the Audis. You want to buy ruthenium at $860. You want to sell it to me, it's $430. Yeah. So we advise investors to just stay away from those. And we have a policy that when we're advising investors on non-exchange traded metals, not only the 4 minor PGMs, but also cobalt and titanium and other metals that we have bought for investors, we will advise them if they're buying an equity of a producer, and if they want to buy the metal, we will only give them our research if they agree that we manage the position. And that has to do with the fact that when investors go to sell, the price just collapses. And since we're in these markets and we work with fabricators and producers and users, they don't like investors coming in and doing that to their markets. So we try to say, we'll be there to do it. And, in the 90s, we had a couple of investors, large investors, for whom we were managing rhodium positions. And they decided that they should liquidate it based on our research. And we sold that rhodium at above market prices in a weak market with falling prices. So we beat the market all the way down in liquidating it. So we have this expertise and we have the contacts and ability to do that. And that's what we do. So we tell investors, just ignore those 4. In terms of platinum palladium, we had been telling investors to buy these things. We are now telling them that we would not be long-term investors in platinum or palladium.
Great information there. Let's talk about uranium for a moment, because
Let me just clarify.
Yeah.
As I said, the big negative for PGMs in terms of supply and demand is falling supply at the major producers. That opens up an investment opportunity for platinum and palladium with some of the North American companies that are looking to develop new mines. So if an investor came to us today and said, I really want to invest in platinum palladium, I heard you on the Jesse Day So, but, I want to invest in these things. We would have them invest through some of these Canadian equities. Not all of them, because some of them have been around for decades and they haven't moved forward. But there are some very interesting properties with good management on top of them. So I think that's the only PGM investment opportunity that we're interested in at this point. You wanted to talk about uranium.
Yeah, absolutely. And that's excellent to have that clarification as well. Perhaps no commodity at the moment is more hyped than the uranium sector. We obviously saw a large run up in the price of spot uranium before correcting a bit. A lot of the equities appreciated in value as well. We're now experiencing somewhat of a pullback. Is this a time to take profits if you're a uranium investor, or do you think there's still a long ways to go in the for the potential of uranium prices to rise?
I would probably be taking profits if I were a uranium investor at this point. The reality is that while nuclear power makes a tremendous amount of sense, and the Indian government and the Chinese government and industries are pushing uranium nuclear power plants, but they're taking a long time to build. And you have some very interesting new small power plant technologies. All of that stuff's going to take a long time to come. And most of the uranium that's bought by power plants is not bought at the spot price. Spot price is for topping off. It's usually long-term contracts with a variety of issues attached to that. So I think that while we look at nuclear power and we say this is something that should be an integral part of the move to cleaner energy technologies, the reality is that the industries are not moving that way rapidly. In addition to which, in the 1970s, the US government was convinced by the Western uranium mining industries to ban reprocessing nuclear fuel. As a result, we have a lot of nuclear fuel stacked up in the United States and other countries, and we've had trouble trying to deal with that. That stuff can be reprocessed and reused. And if the U.S. government were economically driven instead of politically driven, which I don't see in the near future, you could get rid of that reprocessing ban. The United States, Sweden, and other countries. France reprocesses it. About 80% of electricity in France comes from nuclear power. They reprocess their stuff. They don't need to buy newly mined uranium. If the United States and other countries did that too, it's not particularly good for uranium mining, and it's not particularly good for spot uranium prices. So I would be a profit taker in the uranium sector because the price has risen purely on investment demand. Plus, you have these uranium funds, which are sort of like roach motels. Money pours into them, they buy stuff, and then when people decide to take profits, everyone sees them selling. Everyone knows that they're selling. Depending on how they're structured, if it's an ETF type of structure, the managers have no discretion. They can't say, "Well, I have to get rid of this dollar value of assets over the next 3 months," the way a hedge fund has time. If you're a hedge fund investor, you have to tell them before the beginning of the quarter, I want to liquidate over the next quarter. And the hedge fund manager has 3 months to work his positions down. With ETFs, it's like, no, I'm selling today, you sell today. So everyone sees it, and you can just see it spiral down.
Let's talk about copper now, because it had quite a run recently, reaching over $5 a pound before correcting and now starting to rise again back towards that $5 range. We've seen a variety of bullish reports come out over the last year or two, proclaiming that the demand for copper is going to be so big because of the energy transition, and the amount of mines currently online and in development are nowhere near reaching the required supply. What are your thoughts there, and how do you expect copper to perform moving forward?
We're bullish now on copper. It's interesting because we actually did have a large surplus of supply last year in the copper market, and yet the price was rising. So our view, on an ultra short term basis, is that the price could come off a little bit, but we're looking for higher copper prices. Probably not as high as some of the promotional reports that you refer to, but we do see higher copper prices because it is critical to the energy transformation. It's also critical to transportation build out too. So, it's a very important metal. Uh, and we see stronger demand. We've seen that large surplus from a year ago disappear. So there's still in our calculations a small surplus, but it's much smaller. You've seen a big shift in copper inventories away from London and New York. Well, London's pretty flat. I think about a but you've seen metal coming out of New York and elsewhere going into Shanghai and China, and I think that's indicative of where the stuff's being used to manufacture stuff, and also the Chinese efforts to revitalize their economy. So our expectation is the copper price probably does rise. We're looking for it to trade in kind of a big range right now. We tend to think in LME price terms, 10,000, $8,000, $10,000 per metric ton. In COMEX dollars per pound terms, maybe it trades between 430 and 480 in the near term, with higher prices later. With the proviso that if we go into a recession, that could delay the period of higher copper prices.
Great. Well, Jeffrey, this has been a fantastic conversation. Thoroughly enjoyed it. For those who want to learn more, tell us about the CPM group. And if there's anywhere else you'd like to direct people online, feel free as well.
Obviously, we do a lot of fundamental research, supply, demand, estimations, calculations. We've been around since the 1970s in various permutations. We started off as the J. Aaron Research Department, which became the Goldman Sachs Commodities Department when Goldman bought J. Aaron in '81. In 1986, I was running that department, and I spun it off and set up CPM Group. We wanted to be an independent, unbiased, no conflicts of interest commodities research and consulting company. We produce a tremendous amount of work on gold, silver, platinum group metals, copper, uranium, high purity manganese, molybdenum, tantalum, niobium, all sorts of metals and commodities. And people pay us to be right. We have projections from the ultra short term, the next 2 weeks, to 10 years for most of the metals that we follow. Some of the metals like PGMs and high purity manganese, we take out beyond 10 years because they're heavily involved with the energy transition. And so, like, we take our PGM estimates out to 2050 right now because the next 10 years don't necessarily show up on supply demand factors in the auto sector. You really want a longer term perspective. Our website is cpmgroup.com. There's a lot of free reads, free videos. We do twice a week, we do free videos on YouTube about a variety of topics. I think you mentioned one or two. And then we post those and other things for free on our website. And you can also buy our gold or silver or platinum yearbooks. Next week, I think it is already the 16th or 14th. I think it's the 16th. We are releasing our 2024 Platinum Group Metals Yearbook. We've already released our gold and silver ones in March and May, respectively. PGMs comes out next week in the middle of July. And you can buy those for like $160, 200, 300 page books with pretty much what you need to know about these markets.
Great. Well, I'll put a link to the CPM Group website in the description below, as well as the YouTube channel. Thank you once again, Jeffrey, for coming on and sharing your knowledge with the audience.
My pleasure. Thanks for having me.
And thank you for joining us today. As a reminder, for all of your precious metals needs, head to arcsgo.com and contact the owner, Ian Everard, today at 307-264-9441 or by email at ian@arcsgo.com. And make sure to tell him that Commodity Culture sent you. And I'll see you guys in the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.